안녕하세요, 여러분들. 반갑습니다.
Good morning, everyone. Today, I am going to be moderating this session. I am John Lee. I'm the CEO of Meritz Management. In this session, I think a lot of you could be very curious about the global investment strategy. A lot of us are investing in American stocks. I think last year, about 20 trillion won has been put into American stocks. And we see from the news that the interest rate is going to change. So we think about these news a lot. And we also talk about tapering issue. We also talk about the pandemic and how the effects of the pandemic are going to be taken out of the economy. And if that happens, then tapering is going to happen. So we have a lot of concerns surrounding the American economy as well as the global economy. So I think we're going to use this session to meet up to your curiosity. We have been seeing the news, and you probably might have seen David Kelly, Dr. Kelly from JPMorgan Asset Management. He is the chief global strategist. He also appears on CNBC and other outlets. So we talk about the Biden administration, taxes, tapering, if tapering is really going to happen. And the day before yesterday, the U.S. bond market was on the rise. This means that there isn't that much pressure on the interest rate. And we also have some concerns surrounding a possible inflation, and that is seen to be very little. So the U.S. government won't go into tapering very quickly. They have some flexibility from seeing that the bond market has risen. So about 30 minutes ago, we were thinking about what to talk about in this session, and Dr. Kelly was very, very insightful, so I think this session is going to be helpful for all of you. So we're going to talk together with Dr. Kelly, and I hope this is helpful to you.
Hi there.
Yeah, where are you calling from? From New York?
No, in Boston. I live about 25 miles northwest of Boston in Massachusetts.
I see. It must be very late.
Yes, it's about 10 p.m. here.
Okay, thank you so much for participating at this event. I think the Korean investors are very, very appreciative for your precious time, spending your time talking about U.S. economy and stock market and overall situation, the job market and tapering. There are many questions. Korean people are very anxious to hear from you. So why don't you, David, why don't you introduce yourself to our Korean investors?
Yes, well, thank you very much. So I'm David Kelly. I'm Chief Global Strategist for JPMorgan Asset Management. My team is based in New York, and we have another team in London and one in Hong Kong. And so we have strategists around the world who try to understand what's going on in economies around the world, what's going on with monetary policy and fiscal policy, and what it all means for investors. And so we spend a lot of time thinking about where are interest rates going, what do stock market valuations look like, what's moving markets, and how should investors be positioned as long-term investors in this kind of environment. So that's what I do day to day, and I'm very honored to be able to join you this evening to talk about some of these questions.
Oh, thank you so much again. That Korean investors starting last year, pandemic, right after the pandemic, all of a sudden, many Koreans investing outside of Korea, especially U.S. market. So last year alone, about $20 billion were purchased for U.S. equities. So so far, they weren't very happy about their performance. They made some money. However, they don't have much experience in investing outside of Korea. So your insight, your advice is very, very valuable to those investors. So what's going to happen next? So far, U.S. market has been pretty good for the last 10 years, 20 years. However, what's going to happen next? Interest rate, inflation, the job market, and more importantly, tapering. Is it going to happen in November? People say it's November, U.S. government will start tapering. And that is really worrisome to some investors. So your view and your advice, your insight can be very helpful for the Korean investors.
Well, thank you. I'm happy to answer all of those questions, or try to answer those questions in order. I think it's important to think about what's going on with the pandemic in the United States. I think it's important to think about fiscal policy and what the Biden administration is trying to do. And then I think once we understand that, I think we have to think about how's the economy behaving, how's unemployment behaving, what's inflation doing, and what does that mean for monetary policy? And of course, part of that is tapering. Part of it's eventually some increases in short-term interest rates, both in absolute terms and also relative to stock valuations around the world. So there are lots of pieces to this, but I think it starts with understanding both what's going on with the pandemic and then also what's going on with fiscal policy.
Okay. How about the valuations of U.S. equities? I think that is kind of a stretch too much, and some people say it's a very demanding valuations. Do you think the U.S. market, your opinion is still bullish about it, or some people say that the other side of people say there will be 10-year bearish market waiting, so be careful in investing in U.S. equities. What's your view on that?
Well, I don't think you can tell when you have bull markets or bear markets in the short run. I don't think that's possible. But valuations are very important. Valuations are important because they determine long-term returns. They don't tell you very much about what the market's going to do in the short run, but they tell you a lot more about what markets are going to do in the long run. So the S&P 500 is selling at about a PE ratio of 21 times expected earnings over the next year. And that is high by historical standards. It's about 1.3 standard deviations above its 25-year average. So I do think the market is expensive, but I think the market can stay expensive for a while because really for two reasons. First of all, earnings growth has been extremely strong. And I think there is still plenty of momentum in the economy as it recovers from COVID-19. And I think also there's plenty of potential for earnings growth. But also, we still have very low interest rates. And you can't think of stock valuations in a vacuum. You have to look at them relative to local interest rates. So when interest rates are very low, that discourages people from putting money in the bond market, and it keeps those valuations high. We do think the Federal Reserve will begin to raise interest rates. We think they will begin to taper, probably starting in December. And I'd be happy to sort of lay that out more carefully. And we do think that long-term interest rates will move up, but they will still remain relatively low by historical standards, not much more than the rate of inflation. And because of that, I think we can sustain high stock valuations. It's just the growth in stock prices from here, I think, will be much more muted. And of course, there is the danger of a correction at some stage, but we just don't know how to time that correction.
Well, yesterday, Korea time yesterday, there's a rally in the Treasury, and the CPI number is quite low. Some people suggest that probably there is a room for delay in tapering from the U.S. government perspective. What's your view on this?
Okay, so the CPI number that came in, it did come in a little cooler. It's still the fourth consecutive month in which year-over-year CPI inflation has been above 5% in the United States. So it still is pretty high year-over-year. What we saw in that number was a big drop in airline fares. They were down almost 10%. You saw a drop in hotel rates, down about 3%. And what that tells you is the Delta variant was having an impact on the economy in slowing down travel and entertainment in the month of August. But if the Delta variant diminishes in the next few weeks, which we think it will, then we expect that reopening will resume, and we think we will see stronger demand for airlines and hotels. And there's still plenty of supply shortages, the supply chain issues, which are keeping inflation high. So inflation may have peaked. It may come down somewhat, but it will still remain higher than it's been for many, many years before the pandemic. And from the Federal Reserve's perspective, remember, they're not talking about 5% inflation or 4% inflation. Their goal, as measured by the personal consumption deflator, is inflation of just 2%. And we're well above that. And Jerome Powell has said that we're above that. So let's talk about the timetable for tapering. The Federal Reserve meets next week, and then the next meeting after that is on November 2nd and 3rd. I do not expect them to make any significant announcement next week. And the reason I don't think they'll make an announcement is two reasons. First of all, we have got this economic weakness and we have the Delta variant, and nobody knows exactly what this is going to do. So they'll want to see, does the pandemic subside again as vaccination levels go up? That's the first thing. But second of all, there's a lot of uncertainty about fiscal policy in the United States. The debt ceiling has to be increased by about the middle of October to prevent a crisis, and it's not clear politically how that's going to happen. In addition, the Democrats are proposing about $3.5 trillion in spending. The Federal Reserve will want to see, well, does that bill pass? Or does a smaller bill pass, and how does that affect the outlook? So I think they want to see what happens with fiscal policy and what happens with the pandemic before they make a move. But that still means that at their meeting on November 2nd and 3rd, they should be able to, at that point, lay out a timetable for tapering. But what they have also said, and Jay Powell has said this a number of times, is they will give markets notice. So if they lay out a timetable for tapering, they can't start their tapering in November. I think they will start their tapering in December. And what I think they will do is this. Right now, they are buying $120 billion of bonds each month. 80 billion in treasury bonds and 40 billion in mortgage-backed securities. What I think they will do is reduce that by $15 billion per month. So in December, it will be $105 billion. By January, down to $90 billion. And so on until by July, it'll be down to nothing. So that's what I think they'll do. And then if the economy continues to grow with inflation running above 2% in the second half of next year, I think they will do a first hike in the federal funds rate in December of next year, taking the rate from its current range of 0 to 0.25% to a range of 0.25% to 0.5%. So I think that will happen at the end of next year. But I think tapering is still likely. I just think it is always more likely to start in December rather than November.
Yeah, so a little bit more on tapering issue, that timing. You said December that the tapering will happen, but what's the implications to stock market around the world? Especially Korean investors, they're very concerned. You know, all the paper, media talking about tapering, it will happen. Then it's a really big negative implications to the market. But I'm telling people that's not the case. If the economy is recovering, it's a good sign that now we're going back to normal. Then, as you said, the interest rate is so low, the money cannot go to fixed income that as people are worrying about. Is that safe to say that not to worry too much about tapering, or still you think it could be a problem?
Well, I think that there could be many different problems. So let me come back to that. But on tapering, I think people expect it. And usually when people expect what the economy is going to do, then, or what policy is going to do, that does not negatively affect the market. So I think the market will fully expect this reduction in bond purchases. I do think it will push up long-term interest rates. We have a 10-year Treasury yield of about 1.3%. I think that will go up in about 25 basis points per quarter over the next year. So I think it will go up a good deal as the economy recovers and as uncertainty diminishes and as the Federal Reserve tapers bond purchases. But for the stock market, it's impossible to tell whether this is going to cause a big correction. Sooner or later, we will have a correction, of course. But it's very hard to time that. And in fact, if you think about it, the problem with timing markets is you have to make two good decisions. You have to know when to get out, and then you also have to know when to get back in again. And I think that's a very difficult game. I think a better thing people should look at is look at valuations in the US equity market, but look at valuations around the world. So if you first of all, within the US market, growth stocks and mega cap stocks, the biggest stocks in the S&P 500, are quite expensive. But value stocks and more smaller stocks are not that expensive. So I think for international investors and for US investors, I'd recommend taking an active approach to the US market and making sure they have enough money invested in value stocks as opposed to just buying the whole index. In addition, around the world, markets are not as expensive as in the United States. International markets in general, or non-US markets, have PE ratios which are about 30% lower than the US. And that difference, that discount in international markets is the largest that we've seen in many, many years. So I do think that there are cheaper equities overseas. Nobody likes to see higher interest rates, at least in the stock market. It could hurt stocks temporarily. But I think the most expensive stocks, the ones with the highest PE ratios, are probably the most vulnerable to rising interest rates. And I think there are plenty of opportunities for active investors in US equity markets and in global equity markets.
Is that, are you suggesting to your client that moving some money away from growth stock to value stock, is it safe to say that, or major adjustment to their portfolio?
Yes, I mean, we always have to look at tax consequences for moving money around, and that's an important issue, particularly when taxes may go up next year, and perhaps we will talk about that. Yes, I do think that it makes sense. A lot of investors are underweight value and overweight growth, and I do think it makes sense to invest more in value, firstly because value stocks are cheaper, but also as the Delta variant fades and as the economy reaccelerates in the fourth quarter of this year and into next year, that should help value sectors more. It should help financials, it should help energy companies, it should help industrial companies. So we think these companies will do better in a strong cyclical rebound. And it's not just a rebound in the United States. I think that the vaccinations that are going on all over the world will allow the whole global economy to pick up at the end of this year. And that should be a good environment for more cyclical stocks and for value stocks.
Let's move on to our labor market. That still there are two sides of that, saying that the labor market is now too tight. It's very hard to hire people, but still, 8 million, 9 million people still unemployed. So that's a good indication that there's a big impact on inflation as well. So what is your view on that, the labor market?
Well, I think that's right. We have 8 0.4 million people still unemployed in the United States, but we have 10.9 million job openings. So we've got 2.5 million more job openings than unemployed people, and that is a record high for the United States. So you're right, businesses can't find workers. And I think one of the problems is this pandemic has been so disruptive that there are areas where you have people who want to work, but their job doesn't exist. And there are plenty of areas where businesses want to hire people, but they can't find qualified workers. So it's, you know, if you have such an unsettling kind of an event, there are a lot of people who are just in the wrong place, and it'll take a while for them to find the right job. There have been other issues. There were very generous unemployment benefits, which expired at the start of September. I think that has kept the unemployment rate high. But we think the unemployment rate will come down somewhat over the next few months. However, as you point out, we have seen some wage inflation. When we look at wages, we look at, because of the pandemic, it's easier to look back over the last 2 years, not just over the last year. And over the last 2 years, the average annual growth in wages for normal production workers, that annual average growth is 4.9%. That is the highest it has been since 1983. So essentially in 40 years. And we think that is wages are going to continue to rise very strongly. I think that will impact corporate profits next year somewhat, but it also is one of the reasons we expect inflation to be higher over the next few years than before the pandemic, because businesses are going to have to raise prices because they have to raise wages in order to attract new workers.
Let's move on to some the politics with the new Biden government, tax hikes, and where the dollar, direction of the dollar, the weakening or strengthening. So I think that there's also that many people are very curious about your opinion.
Yes. So let's start with the Biden administration and their plans to push some legislation through Congress. So right now, the Biden administration is trying to push two bills through Congress at the same time. An infrastructure bill, which has got some support from Republicans, and it will be about $1 trillion. But there is a bigger bill called the reconciliation bill, which they can pass with just Democratic votes. And that's about $3.5 trillion. And that would be significant further stimulus to the economy. However, in order to pass this bill, they need all the votes of all the Democratic senators. And there are two senators, Senator Joe Manchin from West Virginia and Senator Kristen Sinema from Arizona, who have said they won't vote for a $3.5 trillion bill. So in order to get this bill through, the Biden administration is going to have to reduce it to maybe $2.5 trillion. At the moment, I think both bills will go through. And also they have to go through, I believe, by sometime in the month of October, because on the reconciliation bill, I believe we may see an increase in the debt ceiling attached to this. And we need to increase the debt ceiling in the United States. It's a silly law which limits debt, but the Treasury Department will run out of money by the middle of October, and so they need that debt ceiling increase to go through. So I think that by the middle of October, you may see an infrastructure bill, a smaller stimulus bill, and the debt ceiling all go through at the same time. Now, within those bills, the president is proposing, and the Democrats are proposing some tax hikes. What I think you will see at the end is the corporate income tax rate in the United States will go from 21% to 25%. So before the Trump tax cuts, that corporate tax rate was 35%. Then it came down to 21%. Now it would go back to 25%. But it's not as big as some people fear. I think you will see higher taxes on upper income individuals. I think you will see somewhat higher capital gains taxes for upper income individuals. But again, it's not big enough to really derail markets. It will hurt markets a bit of these tax increases. But because the moderates in the Democratic Party will only vote for about $2.5 trillion of spending over 10 years, and probably only be willing to vote for about $1.5 trillion in tax increases over 10 years, I don't expect those tax increases to significantly disrupt the U.S. economy.
Mm-hmm. So I think that the capital gains tax, if the capital gains tax is increasing, then the demand for equities may be less attractive, as people generally think. But you don't think that that's not significant enough?
Not too much for two reasons. First of all, the increase in capital gains taxes is only going to be for households that earn over $450,000 per year. At least that's the current proposal. But also, importantly, they will backdate, we believe, the capital gains tax hike. So even if they pass this legislation in October, they'll say this tax hike applies to anything that you sold, say, back to September or August. So by the time the bill passes, it's too late to sell to avoid the tax. And I think the level of the tax is not so high that, I think that they are proposing an increase in these taxes for upper income individuals, but the level is not so high that I think it will cause a big sell-off in markets.
Mm-hmm. Well, back to the issue of interest rate, that I think that it's inevitable, as you indicated, sometime next year, later next year, that rate will be higher. But looking beyond that, like a 5 years, 10-year time frame, I think the magnitude of inflation or interest I know it's very difficult to predict 5 years. However, that as an investor, that trying to understand what's going to happen after economy reopening, what kind of things expected, for the medium or long term, how the economy will behave. So do you have any idea that as an investor, what kind of things expected for the next 5 years or possibly 10 years?
Sure. In my group in JPMorgan Asset Management, we work on some long-term capital market assumptions, which we publish every year, and they look out over the next 10 to 15 years. So we spend a lot of time thinking about this. We think that most likely interest rates will stay low by historical standards. So we may get to a point where at least we don't have negative real interest rates. So interest rates on 10-year bonds about the same as the rate of inflation. So that would be higher interest rates than we have right now. But certainly that would be still much lower than we've seen historically. And one of the two reasons for that: one, we think central banks will be anxious not to allow long-term interest rates move up too quickly. So I think if rates move up too quickly and the economy is soft, I think they will do some more bond buying. But the other thing is that there is great inequality in the United States, and that has increased over time. And one of the results of inequality, if you think about it, if you give a lot of money to lower income people or middle income people, they will spend the money. If you give money to the richest households, they will save the money. They'll put it into markets. And so what's happened is over time, as richer households have got more and more of the national income, they have funneled it towards markets. And that's why for many decades now, we've seen consumer prices move up very slowly, but we've seen stock prices and bond prices move up very quickly. So money has been moving into financial markets. I think that will probably continue. And if there's still a lot of money moving into financial markets, a lot of people trying to buy bonds and stocks, that should hold long-term interest rates down in the long run. So I do think long-term interest rates will be I think inflation will be higher and long-term interest rates will be higher than they were in the last few years before the pandemic, but I don't expect them to explode to the upside. The thing that would make me change my mind, though, is if we have some sort of political revolution and you see people raising taxes on rich people and cutting taxes and pouring money into the pockets of lower and middle income consumers. If that happens, then maybe you get more significant inflation and higher interest rates in the long run. But for the moment, I don't see that happening. I think inflation will be moderate in the years ahead, and I think real interest rates will be close to zero in the long run, even as the economy is close to full employment.
Is that because the real interest rate is negative, so it's less attractive for the fixed income investors? Mm-hmm. Is it safe to say that, right? So that
absolutely.
So that the equity market, even if it's some demand, the demanding valuations, still there's more reason to be staying in the stock market than moving to fixed income.
Yes, people call it the TINA market, which TINA stands for there is no alternative. Mm-hmm. And I think that has really helped the stock market in recent years. But of course, some other, I think people should be cautious. I don't particularly like the U.S. bond market, but I do think people should be invested very broadly, have some alternatives, have non-U.S. stocks in a portfolio as well as stocks, U.S. stocks. I think overweight value versus growth, but be diversified because there could be another shock. I mean, I think particularly this week in the United States, we remember 9/11, which was a very big shock to the United States. Sure. But then we had the great financial crisis, which also was a big shock, not expected. We had a pandemic, which was a big shock, not expected. So you should expect the unexpected. And the best way to protect against the unexpected is to be very broadly diversified.
I see. Let's talk about the currency, the U.S. dollar. Mm-hmm. So Korean investors now, many investors are investing in dollar, saying, predicting that dollar will be strengthening. What's the view on that?
I don't think the dollar will strengthen over the next 5 years. It's hard to say in the short run because the U.S. I think will reaccelerate, and I do think that the Federal Reserve, while it is very dovish, is not quite as dovish as the Bank of Japan or the European Central Bank. So I think U.S. interest rates will probably move up relative to international interest rates in the course of 2022. But everything else says the dollar ought to fall. The U.S. economy is going to slow down because we're out of workers. We talked about a low unemployment rate, but a big part of this story is the baby boom generation in the United States, the generation born in the 1960s, a huge number in the 50s and 60s, they are retiring. And so that is hurting labor force growth. In addition, we've seen a big drop in immigration, partly because of the pandemic, but also because of policy introduced by President Trump. And those immigrants used to help the labor force growth. So we think labor force will grow more slowly, the economy will grow more slowly. And if the U.S. economy is growing more slowly, the U.S. trade deficit is very big. I think it will continue to be very big. That should put some downward pressure on the dollar. And also, frankly, the administration, the Biden administration, will want to have a lower dollar. I don't think they intend to pursue the aggressive tariff policies of the Trump administration. But if they want to improve the trade position, I think they will be in favor of a lower dollar. So overall, we think the dollar will come down over time. We can't predict exactly when. And maybe that means some investors could want to hedge their U.S. equity investments in terms of currency hedging. So I think that might make some sense in the long run. But we do think, and we don't think the dollar will collapse, but we think it will drift down. So I think that will hurt the return on U.S. equities from the perspective of a Korean investor.
Oh, I see. Having said that, the population is getting older. That may hurt a little bit about economic growth. Could you touch on some real estate as the outlook? The Koreans, especially because I'm asking you, these real estate issues, is that average Korean people, their exposure to equity is very, very low. Especially their retirement money is only 2 or 3% in equities. But almost 70% or 80% is allocated to real estate. So I think it's a very dangerous situation. But what about the U.S. situation, that the average household, the exposure to real estate and the outlook, and so, anything that you can say about real estate?
So first of all, U.S. investors have much more money in the stock market. Particularly richer investors have much more money in the stock market. Americans do like to own their own homes also, and home prices have gone up. But for the richest investors, they have much more money in stocks. Real estate is challenging around the world because of weak demographics. So you've seen the population is aging, the number of babies born every year is diminishing. And so it's not just a US problem. I think it's a Korean problem, it's a Japanese problem, it's a European problem, it's a Chinese problem in terms of the population getting older. As that population gets older, the need for more housing diminishes somewhat. But at the same time, if we think there's going to be more inflation, we do know that real estate tends to be a pretty good protection against inflation. Now, having said that, so I think the outlook is somewhat mixed. The demographics are negative, but the prospect of inflation is a positive for real estate. But I think you then do have to look at piece by piece by piece of real estate. So I think in the short run, the housing market looks pretty strong in the United States. Mortgage rates are very low. I think people want to buy a home for stability and as an investment. So I think demand is good. But over time, I think the lack of population growth will cause that to fade. I think if you look at some kinds of commercial real estate, I think you will see improvement in retail. I think you'll see improvement in hotels. I think you will continue to see strong growth in warehouse space as the pandemic comes to an end and people get back to traveling more and I think also shopping more. So I think that will be fairly strong. I think the office sector, though, is very troubled, particularly downtown offices, because one of the things that's happened during the pandemic is people have actually gotten to like their home office. I mean, I'm speaking to you from my office in my house in Acton, Massachusetts, which is, as I said, about 25 miles northwest of Boston. It's out in the country. It's very nice. There are lots of wildlife, deer and chipmunks and rabbits. It's very nice. And it's much nicer than my office in New York. And I'm not alone in this. Everybody's figured out how to make a nice home office in this pandemic. They don't want to go back to downtown offices. So I think there will be a lack of demand for downtown office space for some time here, and that will hurt that part of the sector, of the market. So I think real estate investors ought to be careful, look at different parts of the market, but also I'm going to get back to what I said at the outset. It's so important. You don't know what risk is going to hit you next. It's so important to be diversified. And for Korean investors, that means don't put all your eggs in the Korean basket and don't put all your eggs in the real estate basket either. I think you need to spread out your investments in different types of investments and spread those investments out around the world, even if the outlook for real estate looks reasonably good as a protection against inflation.
If probably this is a little bit personal question, that do you think that after economy reopens, you think you're going back to New York or are you staying in Boston? Well,
no, I will be back in New York. I've always lived in Boston anyway. I actually The pandemic has not really disrupted my life too much. I used to do this quite a lot. I do intend to spend more time in New York personally. I think New York is, even if I don't spend too much time in my office, it's, the center cities are exciting places. And I think the use of space in the center cities will change a bit, but people still find the suburbs boring, and they find the big city interesting. And I think that will still be the case after the pandemic is over.
In Korea, what I'm doing in Korea is I'm trying to promote the equity culture. The Koreans should buy more equities, invest. As you indicated that Koreans should diversify their the assets. But in generally, people say in Korea still that real estate is a good investment. They never fail. That's kind of a it's a kind of belief that real estate is a real asset. It doesn't go away. Stay there. And if you stay long term, then you make money. That's a typical the typical thought that Koreans have. But I'm trying to saying that equity investing is much more important. It's good for the economy. Also, that investing in equity is much more over the long term, much more I'd say attractive in terms of return perspective. What would you say to Korean investors that how are you gonna say you have to buy more stocks if you agree with my opinion?
I do if you're overweight real estate. First of all, yes, real estate can go down. In my native Ireland, we had a big property bubble which collapsed dramatically in 2007, and that a lot of people ended up with negative equity, and they hurt themselves very badly by that. And that happened, of course, in the United States too, and we ended up with the great financial crisis. So absolutely real estate can go down as well as up. I think also it's important when investing in stocks to realize you're not just betting on one company. If you do it properly, you're betting on the whole global economy. And if you have a forest, and you look at the forest, and I pick one tree, and I say this tree will be fine. This tree will grow. You can say, I don't know. Maybe it will be healthy. Maybe it won't. But if I said the forest will grow, of course the forest will grow. And so the whole global economy will grow. And so I think it's important for people investing in equities to spread it out and realize that they're not making a bet on this stock today doing this. They're betting on the whole global economy growing over time, generating profits, which will push up the value of equities. I still think, of course, you have to look at valuations. But for investors in general, I think it's just important to space it around. Don't have all, if something goes wrong with the Korean economy and Korean real estate falls in value, people could find themselves in very serious difficulties. It's much better to spread around your investments to a lot of different places. And just because you don't have the thing about, I understand real estate. My father used to love real estate. That's all he'd invest in because you can see it. But just because you may not see Coca-Cola's headquarters in Atlanta, but I assure you it's there. They do make the product. And you could, I think around the world, there are many companies who are generating very good profits, will generate good profits going forward. I think it's important to invest in very broadly.
Great. Listening to your opinion or your views, and I think it's a little bit comfort that as an investor, like other Korean investors, especially last year, they began investing in equities. They have to stay long term, and then there could be some hiccups, but you can never time the market, what's going to happen, when it's going to happen. So I think that, thank you so much. But one area I'd like to ask you that this is something very unique, the crypto investing. That many young generations in Korea, they invest in cryptocurrency very, very aggressively with borrowed money. So I think that your opinion, your advice to Korean people, especially young generations, could be very helpful.
Yes, I think that's quite scary, to be honest. So first of all, cryptocurrencies are very volatile anyway. You could lose a lot of your money quite quickly. But if you borrow money, if you leverage to do it, of course you could make more money, but you could lose more money very quickly, and it's a very dangerous thing to do. So that's, I would not put a large chunk of my net worth or wealth in any one asset, and certainly not in cryptocurrencies. But also, there's a fundamental problem with cryptocurrencies, and particularly let's talk about Bitcoin. The problem with Bitcoin is what is it? Is it a currency? If it's a currency, it needs to be stable. It needs to be a stable unit of account, a stable means of transactions, a stable store of value. For people to actually use it for transactions, the person, if I buy a car from you and I'm going to pick it up on Friday, you need to know what I'm paying for it. And if I buy it in cryptocurrencies on Monday and I pick it up on Friday, you don't know what you're going to get. So that means it's not a currency right now. It doesn't work as a currency. But if it ever did work as a currency, then it stops going up. Why are people investing in Bitcoin? Because they think it's going to go up. So it can only go up if it can't actually be a currency, in which case it doesn't really mean anything. Because it's simply, obviously there is a limited number of Bitcoins, yes. It's designed that way. Of course, it causes great pollution and so forth, but it's designed that way. But there's nothing to stop me from coming up with Mitcoin or Zitcoin or Davidcoin tomorrow, which has all the characteristics of Bitcoin and perhaps works better. And the problem is, I know people think it's interesting and exciting and new, but you can go back to the newspapers from 20 years ago and find lots of things which are interesting, exciting, and new, which everybody's completely forgotten about, and which have went up and then they went right down. And so I think people need to be very, very careful. If they don't understand cryptocurrencies, and I believe most people don't, then this is not a good way to try to make money. The good way to make money is what you're good at, your profession. And then you use your investments as a way of making that money grow. That's the way to approach, I think, becoming wealthy over time, and not speculating in cryptocurrencies, which I think is just speculation. It's not really long-term investing.
Yes, I personally also do not invest in crypto. The reason that I do not invest in crypto is that I never understand it's an asset or it's a currency or it's a technology. I never understand, the really crypto is about. That's why I don't understand. I never understand, if I don't understand, I never invest in those assets. So I think that's what I tell people. Thank you. You have the same view on crypto. But many people, many people also saying that crypto is a very good asset. And then it's very reasonable to invest some of the money to put in crypto. But I'm still struggling that what is really about cryptocurrency. But unfortunately, many Koreans are buying crypto with borrowed money, and so that's very scary. And so also we have about 9 minutes left. Is that something that I didn't cover, or something that you want to talk to Korean investors? Could it be anything?
Well, I think it's also, I spend a lot of time thinking about what's going on in the United States. And of course, we talked a little bit about the perspective of Korean investors and the importance to invest around the world. But I think it is also important to look at other regions of the world. I think Europe is doing very well with vaccinations. I think the European economy is coming back, and European stocks are very cheap. I think Japanese stocks are also cheap, and I think Japan was slow to get vaccinations going, but that's speeding up. I think there are lots of interesting stories with regard to China. The Chinese economy will grow strongly in the long run, but there are a lot of interesting policy issues. But I suppose the question I get asked most often is, what do I worry about? What are some of the risks out there? And so I think, the first obvious risk, I think, is that we have a lot of populist governments around the world. Right-wing populist governments, left-wing populist governments, but what they're trying to do is just throw money at the problem. And so we have central banks who are providing a lot of liquidity, and governments who are willing to run very big deficits. I do worry that we will overheat the global economy. So that's one risk. And also, I think there are geopolitical risks. I think with a rise in nationalism, you look at what's going on in the Middle East. I'm not too worried about what it could mean for oil, but I do worry about destabilization. As I mentioned earlier, we've had shocks like 9/11 and the great financial crisis and the pandemic. We're not sure what the next shock is going to be. So those are some of the things that I worry about. But I think the big lesson for me from watching crises over the years is the economy is very good at adapting to something it sees coming. It's very bad at adapting to something that hits it from around the corner. And so I think people need to be diversified, not just because it gives them smoother returns, but also because you don't know from what direction the next shock is going to come. So I think it's important to be diversified. I think people should recognize that markets are high, and so returns going forward will be lower. But that's okay. That's what comes of making a lot of money. I think if prospective returns were much better today, it would be because markets have done more poorly. So I think a lot of people have made some money. I think they need to make sure they focus on what's going on with the real economy around the world going forward, and I think focus a little bit more on valuations. And I think the one last thing I would say is when interest rates go up, I think valuations become much more important. If real interest rates are negative, or nominal interest rates are zero, you can finance almost anything. You pointed out some investors buying cryptocurrencies. Would they buy cryptocurrencies by borrowing money if they had to pay 8% or 10% or 12% per year on the money? I'm betting they wouldn't. It's because money is so cheap that they can throw it at all sorts of ideas. But when interest rates rise, it becomes more difficult to buy the most expensive assets out there. So I think as we get past the uncertainty of the pandemic, as interest rates move up, I think there'll be a greater focus on valuations. I think people should make sure they're diversified, but also make sure that overall valuations within their portfolios are reasonable.
Great. I think that we mostly all covered, all the interesting subject that Koreans are very curious about. We have 5 minutes. Probably we can open up some questions from the floor, yes, or from the people participating online. 질문 있나요, 혹시?
Does anyone have a question? Hello?
The Chinese government strongly regulates their companies and gives them political pressure on their companies, and as a result, some Chinese investors want to escape their countries and investing to other countries. And also some other multinational countries are very hesitate to invest more money into China. So my question is, what kind of changes can happen in global value chain due to the Chinese policies?
Oh, okay, I think that's a very good question. I think the Xi Jinping and the Chinese government are more determined to regulate business. I think this is partly because they want to exert more control, particularly on social media companies, and on obviously you saw what they did with private education. I think some of that is just they want to make sure that they exert more control. That does tend to stifle innovation somewhat. And I do understand that that will cause some Chinese investors to want to invest overseas more. It will scare away some international investors from investing in China. I think that's true. But I think the Chinese government is also always in favor of stability. And so there's a limit to how far they will push this because they don't want to cause discontent in the economy or cause real economic problems. And I think we know this because one of the other things that the Chinese government is very concerned about is high property prices and the difficulty that many Chinese people have in setting up a family and buying a place and having a productive life. And so I think the Chinese government does not want the Chinese people to be very discontented because that will destabilize the whole country and potentially threaten the Chinese people. So because of this, I think China, I think Xi Jinping has been quite aggressive relative to previous Chinese leaders in trying to regulate and control private enterprise, really going all the way back to Deng Xiaoping. I think this is the most pushback we've seen on private companies. But I think he will be cautious not to push this too far because they won't want to cause any recession or significant economic problem in China because that would defeat their own purpose of trying to have a more satisfied and comfortable population. So it's certainly something to watch, but we've seen this already reflected in Chinese stock market valuations, which have come down. And I do think there's some opportunities still in Chinese equities. And there's also opportunities in Chinese fixed income, which is not correlated with other fixed income markets around the world. So I think it's something we have to watch going forward, but it doesn't necessarily mean people shouldn't invest in China. I think people just need to watch this closely to see how far the Chinese government are willing to push this.
Thank you, David. I think we have only 1 minute left, so I think that we have to wrap it up. And thank you again for your, very insight. It's very, very valuable to Korean investors. I'm pretty much sure that someday I go back to U.S. I'll see you in person, either in New York or in Boston. So have a good night. Thank you so much.
Looking forward to it. Thank you very much.
Thank you.